Hey, I'm Michael. Welcome back to another video. I hope you're doing well. In today's video, I wanted to show you an easy way how you can find a good long-term investment. And we're gonna do that with finding a good ETF. And we're gonna use two main criteria that I think are important when you find an ETF that you want to invest in for the long term. One is cost, and the second one is diversification within the ETF. But as always, I'm not a financial advisor, so the information that you see here is just information sharing, and it's just my personal opinion. If you want to get more information, go and see a financial advisor that can discuss your personal circumstances with you. But let's go right into it. So I saw in one of my comments someone mentioning a specific investment, and I'm going to share my screen in a second. We're going to have a look into that investment. It's a managed fund, and we're going to start to have a look into those two criteria that I just mentioned, and we see if that managed fund fits our bill, or if we can find another ETF that potentially can be a better long-term investment. So as always, when we go to the internet, the search begins with Google, and the name of the fund that we have is CFS MIF Diversified. And again, that showed just up in my comments, and just a very random example of what an investment could look like. And we're gonna see straight away some facts about this managed fund. Let's have a look what we see. So obviously it performed actually not too bad. It seems like so that pretty much looks like the overall performance of the share market over the last couple of years. And we see that the performance of the last 3 months, 6 months, 1 year, 3 years, and 5 years, it's actually pretty good. So annualized return over 5 years is 7.7%, which is not too bad. Looks very average. When we go further down, let's see if we can find some more information. Yeah, here we can see some infos about the costs. We have the management fee, which is 1%. So total management cost is 1%. No performance fee, which is good. But 1% is for a managed fund is actually not too bad, very average. ETFs are usually a little bit cheaper, but for a managed fund, pretty good. And we say the group name is, it's a Colonia First State. That's the managed fund provider. It has mixed assets and it's growth orientated, and it's in currency Australian dollar. If we go a little bit further down, we see the asset allocation from that fund. And first in this area, we see in what countries that managed fund is invested in. It's mainly Australia. 30%, over 30%, and its international equities is 25%. It has a little bit of Australian government fixed interest. So it says it's growth, but it's definitely not high growth because it still has a part in it to have constant return that are then not that high, but it will obviously provide more security. And the top holdings of that ETF you can see here, again, very Australian focused, BHP, CSL, some banks in here, A2 Milk is in there, and Telstra. And then the next one is Australian government loans, 1%. So 4.75% return on just this one. It's actually not too bad. But yeah, so well diversified, not a bad one. But let's see if we can find a fund that is maybe a little bit cheaper, potentially has a little bit more exposure to just securities, so just ETF and no fixed interest assets. But I think we can take the risk if we want to invest for the long term and long term is 10 years plus. So let's just look on iShares Australia. iShares is a product from BlackRock, and underneath iShares are all the ETFs that BlackRock has to offer. One of the established ETFs providers. There are some other ETF providers out there as well, and I'm not affiliated with BlackRock or iShares in any way, but I think they're just a really good provider of ETFs. Let's see. We want to do the Fund Center, iShares ETFs, and this should give us an overview of what ETFs there are available from iShares. And obviously we want to make sure it compares a little bit with that fund that we had just here. And let's go into, so that obviously had global exposure, and I think that's also the right choice. We want to make sure that we are diversified. So we try to use a fund that has global exposure. So we click on global. And this basically reduces the number of ETFs available, all global ETFs. And we can see this one here is obviously the one with the largest asset allocation in it. So this is probably the one fund that is most popular. It's a global 100. So probably, without going into much detail, probably the 100 largest companies in the world. We could go into detail. The management fee we can see here, but I'd like to have just a normal MSCI World if they have something like that. MSCI World all cap. No, not hedged. This one here. iShares Core MSCI World All Cap ETF. It's actually very, very low management fee. And we're going to see if we find some more details and to be able to compare this ETF with that managed fund that we have. So this is the product fact sheet from that iShares Core MSCI World All Cap ETF. And we can see relatively up to date from December last year. We can see already here the performance of the last years. It looks like it's an ETF that doesn't exist for too long, so for not longer than 3 years, or at least not 5 years, because it doesn't have any performance here. The 1 and 3 year performance is pretty okay when you compare it with the benchmark. And we can also start comparing now the performance. We have 3.73 and 9.9 with compared to 1.6 and 6.6. So this is certainly a little bit better. So 6.6% per year compared to 9.9% per year. So 3% more each year. And if we want to have a bit of an idea of the long-term returns that MSCI World had in the past, MSCI World performance, we would be able to see that from MSCI World directly. So MSCI is obviously an organization that basically a label that provides, and ETFs are able to use this label. So we can see here that is the MSCI World. So it's actually a little bit more. So 1 year performance, this 3 year performance is pretty good, very, very close as well. The 5 years is 12.9. When we compare this with the 5 year performance, that's certainly 5% per year different. That's already quite a bit. And I would expect that this fund will return similar to the MSCI World Index as well. We can see that on the different holdings they are in here. So the top holdings are Apple, Microsoft, Amazon, Facebook. Let's go into this list and have a look. Apple, Microsoft, Amazon, Facebook, Alphabet. Yeah, so pretty much very much aligning. Johnson & Johnson, JP Morgan, Visa, same here. Tesla is within that fund. Berkshire Hathaway, so slightly different, but still very, very good exposure. A lot of exposure into US, over 60%, Japan, United Kingdom, France, a little bit Australia. That's certainly different to the managed fund, but not of a big concern. And I actually quite like that because the US share market obviously performs usually a little bit better than the rest of the world. So we can see now to finish up again on the two things that I think are important. So as I said, there are two things that are important is cost. So how much costs the fund? And we see that now. And what is the performance? So let's look again what the performance was per year over the last 3 years to actually get that compared. The cost for that managed fund was 1%. We saw that here, 1%, compared to, that was here, 0.09%. So just a tenth of that cost. And if you invest, for example, 10,000 Australian dollar into that fund, you would pay 100 Australian dollars per year, and for 10 years you would pay 1,000 Australian dollars. And here you would pay just $1 per year. Sorry, $10 per year and $100 for 10 years. So definitely a little bit less, just a tenth of the overall the cost that you usually would have. And the performance was a little bit better. So we could see that 3-year performance was 9.9% compared to the 6.6% we had here. Again, probably a little bit more risky because it doesn't have this fixed asset and fixed interest component. But I believe if you are investing for the long term, this is a risk that you can take when you invest for more than 10 years. I hope this little comparison was interesting to you, and the two factors and facts that I think are really important, cost and diversification. Again, no financial advice, but I hope it was interesting for you to watch. Until then, I see you in the next one. Bye.